Wealth Migrate's preparing for a show in March in Paris, and one of the requirements of the show is coming in with a PricewaterhouseCoopers audit on the number of investors in the platform. So we're preparing and setting them up to be able to do that. So in that consolidation, the second value point will be that. The third will be there will always be a desire for innovative technology. So there are really cool algorithms being developed. There's really cool metric analysis tools being developed. There's really cool presentation widgets. And those will become interesting products for people who do the roll-up to acquire. So in the consolidation space, though, I think that there's two big movements. There's those who believe that this will be portal-driven, and that there will be, the too much will be that there will be 3 or so big portals. So if you look at this revolution that happened in a similar way when the wirehouses, where you used to pay 8% for a stock trade, and now you pay a flat rate of $8, and instead of wirehouses, we all have an E-Trade, Ameritrade, or a Scottrade account, you know, and you say, where did all the stockbrokers go? And then you realize that your cab driver is managing his E-Trade account while he's driving your cab. That's happened to me in Kansas City. I'm like, come on, man, what are you my cab driver or the stockbroker? He's both. And so you looked, and we ended up with a big 3, even though there was a lot of other players. So there's folks that believe that in this portal space, there will be a big, you know, we'll have an emerging big 3, and I'm sure Fundrise, you know, is seeing itself right on track to be that, you know, one of the real estate ones, or you know, Circle Up is trying to carve out that, you know, consumer product one. We, our community leader honors that and thinks that there's a lot of good metrics to buy that and support that. We actually think that this market isn't about portals. We think that this market is about the revolution of how private capital is secured. And just like there are literally hundreds of thousands of companies raising capital on an ongoing basis, developers, banks, lending institutions, there will always be hundreds of companies that are taking advantage of the technology and the regulatory market. And what we're kind of banking on is there will be emerging lots of 1 or 2 or 3 big back-end providers who allow the diversity of the market to survive. So that's where Community Leader has kind of positioned ourselves. We are banking on or trying to have this market develop so that there are literally hundreds of thousands of portals all across the world that are able to do niche markets and keep capital local and reinvest in the local community, and whether that's a geographic community or a niche market community. That's what we're really about. We're really about how to take the high cost and complexity of running and managing a portal. Our platform's almost a $3 million build at this point that we make available to clients starting at $15,000 to $35,000. That allows folks to operate in the space, and we hope that will mean that the consolidation may be around the back end, but it will allow and maintain the flexibility, the diversity on the front end. So what are we doing on time? We're technically over, right? Do we want to do a couple more or not?
I mean, I think this is great. So, okay. I mean, if your session's now.
Oh, I can, you know, I can talk forever.
Okay, coffee break.
So I'm going to answer 2 more, and then we'll respect the time because we've got some great panelists, and we can get into a lot of these questions with other people that are actually doing it as well. I'd like to talk about the after the raise issue real quickly, and I'm going to bring in the IP, and then I'm going to talk about the trouble red lights in the industry. Okay? So after the raise is critical. I cringed yesterday when my chief compliance officer said that the Community Leader platform supported you from the moment the investors signed up until the moment the raise was done. And I knew that's not what he meant. What he meant was, for us, it's from the moment you sign up to the moment the investor gets their money back. The most critical portion is after the raise. Nothing pains me more than the entrepreneur that just raised capital and is celebrating. What are you celebrating? Now's the time to get to work with other people's money, right? Now's when the real work starts. Now's when you have to fulfill on all those ridiculous commitments you wrote in the PPM, right? Now's when the rubber hits the road. You know, Mark Zuckerberg goes on his honeymoon after his IPO. I'd be pretty annoyed too as an investor, right? Don't go on your honeymoon after you raise the money. So the after the raise portion is the most critical. And I think that the sites that are currently are proprietary or have emerged out of a proprietary stage, who have that long-term relationship with investors and understand that role, will be in a competitive advantage in the long term, because they will have inherently built out the systems to provide that ongoing support. So when I'm talking, and our platform is really ramping up what we're providing clients in this area. And at the San Francisco conference, we'll be doing some pretty big announcements of some innovations in this space, which will be very, very important for the industry. But when I talk to folks, I'm like, what do you do when when an investor dies? What's your system? Are you set up and prepared to facilitate the transition of that through probate? Are you ready for that? What about when you can't find the investor anymore and you need to reclaim those shares? Are you set up to do that? There's a whole law structure for doing that. Are you getting the K-1s out? What if you don't? What if the issuer doesn't? Oh, are you really going to answer the phone and tell them, oh, don't worry, I'm not part of that. I just helped connect you with the issuer. I just helped facilitate the purchase. I'm not part of making sure that the issuer actually does their K-1s and gets it to you. Nothing will kill this industry or an individual portals faster if we don't take seriously the after the raise. And it's not just about ongoing communications, it's about legal disclosures. It's about the infrastructure of fund management. This is a huge issue. And the portals that think that their responsibility ends upon the completion of that raise are going to kill us as an industry, and they're going to kill themselves. So when we're talking with clients about our portal, there's 3 stages of that campaign. Stage number 1 is the preparation. It's getting all your legal documents together. It's creating your company right. It's getting your IP protected. We're in the final stages of the integration into our platforms-based product of an IP evaluation, assessment, and protection tool. Because you've got to protect that IP as you're going in a quasi-public. It's not a public offering, but it's public. You know, there's a lot of people that are going to be looking at it, and a lot of companies are extraordinarily concerned and have misunderstandings about what and how much they can disclose in what types of environments. So we're integrating that as a base part of the product. But that development stage is as important as anything else. And since a crowd fundraise is fundamentally the conversion of social capital to financial capital, you have to build up that social capital before you publish and launch the raise. So helping the client get their social capital positioned and ready to go, part of the development stage. Then there's the raise stage, and everybody's focused on that. We know about that: identity verification, qualification, accreditation, verification of that. We know about legal movement of the money. We've all got different vendors, BankBox or others, that we've integrated to provide that, escrow services, sweep accounts, threshold raises, different types of escrows. Everybody's got great solutions. Everybody's focused on that. And then the third, and the most important, is now you've got investors, right? And the issuer has the investors, and the portal has them too. Just because they are investors that may not be on your cap table, they came through you, and you're going to have to play a role. So I think that one of the competitive advantages of the proprietary platforms is because that's one there, and they've built out those systems and they're migrating those systems online. The other platforms, the marketplace platforms, may be able to or want to say, hey, we're not taking the legal liability in that position, but I don't think the market will tolerate that. So that gets to the trouble sites.
Can I ask you a quick
Could
question?
you please?
Yeah, absolutely. So I have heard different things about different portals, some of the existing portals, limiting the issuer's access to the investors. In other words, the issuer wants to raise $1 million. So the portal creates a investment entity to raise that $1 million.
Right. They're doing a derivative vehicle for the investment.
Right, and ends up writing the $1 million check to the developer, but doesn't tell the developer who the investors are, because the investors are not technically invested in the developer's project. They're invested in the special purpose investment entity.
Yeah.
So the issuer gains no
new investors.
No relationships. So where do you think the industry is going?
Okay, so I'm going to answer that in a couple ways. If you look at the SEC process around the decision of whether a special purpose investment vehicle will be eligible for Title 2 and 3, you'll actually see community leaders' comments. That was one of the areas that we spent a lot of our time on, the legal comments. When we looked at the evolution of the EB-5 immigrant investor space, which was also a kind of a woohoo, wonderful thing. For the first 10 years of that program, when they ran it as direct investments into the operating entity, the crushing costs of the ongoing support killed most of the projects and destroyed the visa program. It wasn't until they started to allow the derivative vehicle that you were able to manage the investor process. So I actually think that there's huge advantages both to the issuer and the investor for a portal operator to take on the legal operational responsibility of managing that investor relationship through a derivative vehicle. And I'm not a lawyer, I'm not the securities person, I'm not the MBA, but we strongly advise clients to consider when that would be the right solution.
Okay.
That being said, issuers need to look at where they're going, and are they getting an investment from XYZ portal, or are they going there to build a relationship with primary investors? And even if it's through a derivative vehicle, then the manager of that investment vehicle has to take extraordinarily seriously their ongoing communication about the issuer back to the investors and vice versa. So I think that there still has to be recognition, right? In the PPM of the derivative vehicle, you're invested in Joe's Pizza Shop, and those investors know that they're there, and Joe's Pizza Shop knows that they're there. And if you try to hide that, I think that's a no-win long-term situation.
Well, yeah, it's not a question of hiding it. It's really just a question of
access even.
Who's going to get, does the issuer own the investors, or does the portal own the investors, or are they sharing them?
Sharing them.
And how are the portals that you are supporting handling that? Are most of, there are issues with investment companies with those derivative vehicles, but putting the legal stuff to the side, are the portals you're supporting, who's owning the investor relationship?
So first, I'll make really clear, we don't. Community leader doesn't. We facilitate it, but on none of our portals do we own any of the investors or any of the data. We are not a big data play behind the scenes. We are providing that infrastructure support. So our different clients have different models of that legal relationship, right? And so, for example, Kent at Next Gen Capital, that's doing a fantastic job of engaging major institutional investors in his platform. Those investors are prominently, the primary relationship is with the portal and as an institutional partner to their platform, but it's co-owned because those investors end up on the cap table of the business as well.
So they're ending up directly on that cap table.
Other platforms like IPO Wrangler, one of your clients, Devin Bosch, he owns the investors, they're his investors. Okay. And he's pulling them together into investment vehicles, which is doing mezzanine financing for companies that are going to go public. And he owns that primary relationship. Issuers are not coming to develop a new investor pool, they're coming for the institutional investment from IPO Wrangler. So the legal relationship there is the investors are owned by the portal operator.
Okay.
So trouble red lights. Number one is it's a $1 trillion industry, but don't assume that the early adopters are going to get it. There's an incredible amount of money to be made, and the existing providers are going to move into it. And you need to figure out how to work with them and not talk about sodomy on them, and figure out how they're partners and potential partners with you, or your site's not going to, and business isn't going to be there. Number two is the ongoing support of investors has to be brought in as a top primary concern. It's not that big when we just started a year ago, but there are deals that are going to go south. There are deals that are going to go zero. There's real estate projects that aren't going to work. And there's going to be investors that are frustrated, angry, and annoyed. And if the infrastructure for supporting that process isn't there, it's going to result in a loss of confidence in the asset class as a whole. Right now, Wall Street is experiencing that retail investors are not going back into Wall Street after the crash, and it's hurting them in a big way. We have an opportunity to pick them up, but we won't pick them up if we operate with the same kinds of problems or low standard of expectation that Wall Street has for itself. Third, that was quite a statement, wasn't it? Just kind of rattled in there. And the third red light is we were built from compliance up. Rick was one of our founding partners, 40 years of securities experience, though he shaves a couple of years off and based on his dancing ability. And we were built from compliance up. There are folks in this industry who don't give a rat's ass about compliance and are going to market and doing whatever they can get away with until they're caught, and are leveraging that money that they raised in that questionable environment into doing the next big thing. And it will hurt all of us who care about doing this right if we don't come up with ways to hold those who don't accountable. This is a community. It is a new emerging sector, and there's more than enough for all of us. And we will all do better working closely together. There is so much opportunity, and by working together with people with a common value of compliance and respect for the issuer and support for the investor, we will all be successful. Thank you.